Okay, good afternoon, everybody. Thanks for dialing in today to the webinar on your lunch break. I know you're all very busy business owners, so I really do appreciate you taking the time out of your day to listen to this. The purpose of today's webinar really is to give you a few hints and tips on the most tax efficient way for you to actually to save for your future. Whether that goals, maybe goals in the future or your retirement and beyond. But also underpinning all of that, helping you understand how to get there and how much you should actually be looking to save and where your income is going to come through from in the future. As I said, this really is, a few hints and tips. Everybody's situation is going to be completely different. So what we will do is we will pick up with you all individually after the webinar just to see if there's anything sort of more that you wanted to take from it, and we can take it from there. So today's webinar will probably last in the region of 20 to 25 minutes. There's a question box that you've all got on your list there as well. So do feel free to put any questions on. So I'll see those come through, and we'll either deal with them during the course of the webinar or towards the end as well. Okay, so that's me. So my name's Liam White. So I'm one of the financial advisors at Capstone, dedicated to helping the gunnercooke partners with their financial planning. Okay, so in the last few days, at the end of last week actually, I spoke to a number of the people on the line just to get a bit of feedback in terms of what they'd like to get from the webinar. And we've tried to actually build all of that in, because I do know that there will be people at different stages of their career. So there might be people on the line in sort of in their 30s and their 40s, and they're really looking to try and build their wealth for the future. But then we've also got people that are approaching retirement as well. So what we've tried to do is build in something that will be relevant for everybody. And as I said, everyone's situation will be completely different. You've got my details on the screen there, so please do feel free to contact me directly should you need to after the webinar. So, as the great Sir Winston Churchill said, he who fails to plan is planning to fail. So financial planning is all about planning. It says it in the title. And I think we've all probably got some kind of loose plan in place, and that might be that we're saving into pensions on a regular basis. We might have been involved in work schemes in the past where, our employers were paying into pensions for us, or we're saving into ISAs. So that is kind of having a plan, because you are saving, but without really kind of working towards a goal. What we really like to do for our clients is actually really develop a personal plan. So, helping you think about, what is important to you. For example, when you would like to retire, what retirement looks like, any other financial goals that you have in place. And actually building a plan and understanding what you want from your future will actually really help us and give you the best chance of getting to where you want to be. And I guarantee you, by putting a plan in place, you are much more likely to have the future that you want. And that's what we are here to help. Okay, so questions that we kind of ask our clients, but I think it's a really good place to start. So what does retirement mean to you? So that could be, when you might retire, a certain age, or how you'd like to kind of work through retirement. Are you going to stop working completely? Are you going to phase it? Is there going to be like a succession from working full time to sort of tapering down, which is what a lot of partners within gunnercooke will probably look to do. But then really thinking about how much income that you need. So like I said, a great starting point, because when you get to 60, 65 or 68, whenever you choose to retire, yes, mortgages will probably be repaid. Children will be, hopefully, financially independent, flown the nest, but you will still have fixed outgoings. You'll have the bills to pay. You'll have your basic lifestyle that you want. But on top of that, in retirement, we all want to enjoy ourselves. So we want to go on holidays. We want to do all the things that we want. So if we can put a number on that and say, this is how much money that I would like to have when I get to 60 or 65, we can then really guide you to what you need to do to get there. And like I said, it will really help you. How are you going to generate that income? So probably about 5 or 6 years ago in the industry, we had something called pension simplification. There really is, and by the way, it's not simple at all, which is fairly typical. But there are so many ways you can actually use your retirement plans in the future. So, and we will come on to that, and that, you know, it's fairly complicated. And in all honesty, it'll probably be a mixture of a number of different sources of income that you will use when you get to retirement. What are the tax implications? So one of the things pension simplification did bring along was the fact that it, you know, it gives you the ability to be, you know, somewhat, you know, stupid with your pension. So when you get to retirement now, you know, you do actually have the opportunity to take all of the money out and spend it without realising what the tax implications are of doing so. Because you'll also give yourself a fairly significant tax bill. So actually understanding what the tax implications are when you get to retirement will also be really fundamental in sort of deciding, you know, what the best way is to retire and generate income throughout your retirement years. Also, are you using your assets to the greatest effect? You know, the investments that you have, you know, if you've got shares or investment funds, are they in the most tax efficient wrappers? Are properties or buy-to-lets, you know, structured in the right way? Are they in the right person's name, etc.? So there's all sorts of things that we can do to get you in the right place. So when you get to retirement, your assets and your capital is working in the most effective way. All very relevant points to think about. So why does retirement planning matter? The simple fact is, everybody's living a lot longer. And I would estimate that most of us will probably live in the region of 25 to 30 years in retirement. And there's a few facts on the screen there, but you know, if you kind of put that into numbers, if you think you've got to almost save between now and your retirement age, so over the next 20 or 15 years, enough money that will actually last you for 25 years. So that's probably a good place to think about it, really. Yes, there will be a state pension, hopefully, at some point. It's been pushed back. So a lot of us have state retirement ages now of 68. The full state pension is in the region of about £8,500 a year. That will give a basic standard of living. I think we'd all like to be in control of our own destiny and be able to ensure that we've got as much money as we want when we want it, rather than being dictated to. So yes, there we go. Okay, retirement going forward. Okay, so retirement for me as a financial planner is not all about pensions. Yes, pensions are a really, really tax efficient way for you to save in many ways. In the fact that they'll give you very good tax reliefs on your business, they'll reduce the amount of income tax you pay, investments will grow free of tax, etc. But more than likely, you will have got investments. ISAs, really, really important with retirement planning, because with pensions, very, very tax efficient on the way in. So the money that you put in, you get a lot of tax reliefs on that, and we'll come on to that. But when you get to retirement, pension income after your 25% of tax-free cash is classed as taxable income. If you've built up ISAs throughout your career as well, and while you're actually earning money, ISAs will produce tax-free income in the future. So when you get to retirement, instead of trying to grow your ISAs and sort of increase the balance even further, you can just turn them into income-producing ISAs that will give you a very good and useful tax-free source of income on a regular basis. Property, a lot of people like property. We've got our own sort of main residences, but people are building up portfolios, buy-to-let income. Although the government and the HMRC are really squeezing landlords at the moment and making it less attractive for people to buy second properties, it does still form a very useful form of fixed rental income when you get to retirement. The other opportunity people have going forward is you've got the ability to downsize. A lot of people are sat on significant equity within their properties. If you've got a family home, 3, 4, 5 bedrooms, that you probably don't need that sort of size home in the future. There is an opportunity to downsize, buy something smaller, release some equity that will, generate good income for you going forward as well. The last box there, so part-time work, but just potentially looking to scale back. And having spoken to many partners, this really is a great opportunity within gunnercooke, whether it's just reducing the number of clients that you're working with or working with your key clients on a level that you feel kind of comfortable with. So you'll be able to supplement your income with money from your pensions and your investments, and we can help plan for that. So retirement going forward, it's not about stopping at 65 and then using your pension for the rest of your life. It comes in many sorts, investments, property, and the potential to carry on working as well. So what is your magic number? So this is a fairly simplistic diagram of how to work out how much you need. So typical client, they might want £30,000 a year, and when they get to retirement, probably going to live in the region of 25 years. So simple maths gives us a fund of £750,000, which is a huge amount of money. And the likelihood is, you probably wouldn't need that much money because, in the early years of your retirement, you probably will spend significantly more because you've got the energy and the health to do so. Later retirement, more than likely, you won't spend as much. So first of all, that takes away from that equation. It's not a bad place to start, but there's a lot more that we can do. Also, it wouldn't factor in for the growth on the investments because, if you do retire at 65 and the money stays there till 80, 85, your money will continue to grow. But it's a very simplistic way to start with a number of how much you might need to generate. So another way we can do it is by building a sort of model for you. So this, I'm going to sort of flick through the next few slides fairly rapidly. But just to give you an example, so this is a couple, Mr. and Mrs. Gunnercooke. They're aged 43 at the moment. So you can see on the purple bar, and they're looking to retire at the age of 68. So the purple line illustrates their working life. Throughout that, there will be some financial objectives. So kids will be going to university, they'll graduate from university. There might be a wedding that you need to fund for your children. You might have the dream of building a holiday home at some point in the future as well. So this is the start of building a financial plan for your future. You get to retirement at 68. So there's two bars there. So there's a green bar and a blue bar. So the first 10 years, we can say, right, you're going to have a lot more health, you're going to have a lot more energy, you're going to spend a lot more money on holidays, traveling the world, doing the things that you want to do. So we can account for the fact that you're going to need much more money in that period of time. Then we've got passive retirement, as we'd call it. So from the age of 80 onwards, not everybody, but a lot of people will probably start to slow down, spending more time locally with family, etc. And more than likely you won't need as much money. So by building a plan, and everybody's is going to be completely different, we can then look at what you need to do to actually get there. So you've got there's a graph here, very, very simply. So the blue lines are what your earned income is. And what we can do is illustrate what your earned income is versus what your outgoings are. We can then look at what your disposable income is. So that's one thing we can use it for. But anything that's red on this diagram, is a shortfall in funding. So this couple, that's you can see at the age of 59, they were looking to buy a holiday home. At the moment, they don't have enough money to do that. So there's a colour of red there. But then in the later years at retirement, there's some red as well. So by knowing that, so that's projecting their investments forward, their savings forward. And we can work out what the shortfalls are. Knowing those shortfalls, we can then accurately say to our clients what you need to do to alleviate those shortfalls. So holiday home, retirement income. So what do they need to do? So by looking at some really interactive and intelligent software, by advising this particular client, they might need to save £900 a month into a pension, and that would completely get rid of their shortfall. For their holiday home, building up an ISA, again, by regular savings. The point I wanted to get across to you by those slides is really, how we can build a personal plan for you, understand your own personal circumstances, and tell you what you need to do or advise you what you need to do to actually get there. Okay, some more factual information. So what can we do with pensions? Okay, so every year we have the ability to pay up to £40,000 a year into a pension, which is a large amount of money. Now, what's the best way to do that? So the partners in gunnercooke, not all, but most, will be operating via a limited company. Now, generally, the best way for you to save is via what we'd call employer contributions. So you're saving money directly from your business into your pension. What you don't have to do is take money out of your business, pay all the income tax to do that, then pay it into the pension. You can transfer money directly from your business into the pension. It's classed as an expense of your business and will reduce your corporation tax bill the following year. So for me, retirement planning, yes, it's about getting money out of your business without paying any tax at all. It's reducing your tax now, and it's planning for your future. Now, working with many partners in gunnercooke, and everyone's at different stages. And because of the way cash flow works as well, there may be some months where you've got significant levels of income coming in, and you've got some months that there might be lower levels of income. So a suggestion that I've always got is, have a look at what's really affordable. So, and it might be a relatively small amount of money, but just start saving into your pension on a regular basis at a level that's affordable to you. Then, as part of the ongoing reviewing process, so we'll work out when your company year end is. So that could be at any point during the year. But say, for example, your company year end was December. A real good tax planning strategy is the fact if you kind of start to review the profits that are built up in your business around about October, then when we get to December, we can say, right, you've had a significant amount of profit build up in the business bank account this year. What you can do is then make a one-off payment from your account into the pension. And for me, that's a really good way to do it because you're not overcommitting yourself on a monthly basis because it'll help with cash flow issues. And then at the end of the year, we can sort of do an assessment, look how the year's gone, and then, if appropriate, we can look to then make one-off lump sum payments as well. At the bottom of that slide, you can see it says, don't forget about 3 years carry forward. Everybody's got an annual allowance, like I said, of £40,000 a year. If you've not actually used your previous 3 years' allowances, you can bring them forward and you can then use those as well. Now, this is an example, and again, big numbers, relevant to some people, but it can be scaled down as well. So in this scenario, we've got a director of their own company within gunnercooke. You can contribute up to £40,000 via an employer pension contribution this year, £120,000 of the previous 3 years. So if you've not made any contributions into a pension, you could make potentially up to £160,000 in 1 year payment into a pension. What that would do, if you did that, is reduce your profit that company year by £160,000, and you would get a corporation tax saving of 19%, which is what corporation tax is at the moment, and that would equate to a tax saving of £30,400. Again, they are large numbers, but on any scale, whatever amount of money you put into your pension, it will reduce your corporation tax bill the following year. So a very, very good tax planning strategy. Something that I just wanted to let you aware of. So a couple of years ago, something called the tapered annual allowance came in. And this is where, although the pension annual allowance is £40,000 a year, there are certain circumstances where your annual allowance is reduced. So if from your business you start pulling out, whether it's via salary or dividends, in excess of £150,000 a year, you will start to reduce your annual allowance. So, and that works on a basis of you'll lose £1 of annual allowance for every £2 of income above £150,000. Now, there are some technicalities to it, so it's not sort of black and white, but it's a very good starting point. So if you're in that position, be aware of how much you're paying into pensions, because you could be facing a tax charge if you're contributing into a pension more than you're physically allowed to. Now, this, just on that point as well, if some people might be aware, some people might not, but it's relevant, is everybody's got what's called a personal allowance. And that's how much money you can earn each year tax-free. At the moment, it's £12,500. So the first £12,500 of income you earn this tax year is tax-free. Okay. However, if you're at a point where you start earning in excess of £100,000 a year, you will start to lose your personal allowance. So much so that when you get to income of £125,000 taken out of your business via salary or dividends, you've now got no personal allowance. Okay, so something to think about is the fact that tax bracket, or that level of earnings between 100,000 and 125,000, you're paying higher rates of tax, but you're also losing your personal allowance. So it's a weird tax bracket that's probably around about 60%. So you'll pay 60% tax approximately on those levels of earning between 100 and 125. So if at all possible, and if that does affect you, what I would suggest is try and keep your earnings to around about £100,000 a year as a maximum to retain your personal allowance. You can then make pension contributions over and above that, or if your kind of lifestyle does demand that you actually need that level of income, it's just something that we need to deal with. However, it's important to be aware of what's happening. Okay, so the reason this slide's there, so it's one point which is what says VCT and EIS. So VCT stands for Venture Capital Trust. Now, these come into play really if you're earning levels of income in excess, high levels of income. So if you're a higher rate income taxpayer, or if you're at a point where you've got a reduced annual allowance for pensions. So if, for example, you can only put £10,000 a year into a pension because your level of income is that high, a venture capital trust is a very good alternate place for you to invest your money. It still brings very, very significant sort of income tax reductions, also produces tax-free income in the future. It's not a subject that I'll be going into any more detail now. It's more on a one-by-one basis, but there are other ways of tax-efficient saving for your future. Okay, so how can you use your money when you come to retirement? Okay, generally 3 standard ways. So you've built up an investment fund throughout your career. You can take 25% of that fund out when you get to retirement, free of income tax. So that's generally a given. People do that. So whatever's there, 25% you can take out. And this can be done from the age of 55. So at the age of 55, you can start to draw on your pension benefits. Further to that, there are other options. So you've got something called an annuity, which has been around for a long time, and I'll go into that in a small amount of detail. You've got flexible access drawdown, and you've got the catchily named UFPLS, which stands for Uncrystallised Fund Pension Lump Sum. So an annuity is effectively a guaranteed income for life. So, for example, you get to retirement and you've got, say, £100,000 in your pension. You can give that £100,000 of money to an insurance company, and in exchange for that, that insurance company will pay you a fixed income for as long as you live. Annuity rates, probably around about 5% at the moment. So for £100,000, they will pay you £5,000 for as long as you live. It's completely no risk. You will always have a fixed level of income. You'll never run out of money. Okay. The downside to that is the fact that if you didn't live very long in retirement, the insurance company will probably win because they've taken more money off of you than they've actually paid you back. That said, it's a very low risk strategy because you'll never run out of money. So that's one way. Flexible access drawdown is effectively where you take 25% of your money out of the pension tax-free. So in that same instance, you've got £100,000 in your pension. You can take £25,000 out tax-free. £75,000 remains in the fund, and that will continue to grow. Then you can simply draw down that money as and when you want. You can say, right, I want £5,000 a year, £10,000 a year of fixed income. That money will pay out to you. and then the money will continue to grow. If you were to pass away, that money will be inherited by your beneficiaries as a pension as well. Then you've got uncrystallised fund pension lump sum, which just allows you to take lump sums out of your pension. For me, I think the answer probably sits somewhere as a mixture of all of them. I think probably what I'd want to do is have a look at what my fixed outgoings are and unitise that. So if I needed, say, £10,000 a year of guaranteed income, I would buy an annuity that will give me £10,000 a year of income. Then whatever's left over in the pension, that's my money that I can enjoy for holidays, etc., and would use drawdown strategy. So I think the answer lies in, a bit of a mixture of all of them, but advice really is crucial, and you don't want to give yourself unnecessary tax liabilities either. Okay, a couple of sides. I think it'd be remiss of me to exclude talking about investments and volatility, because we're in fairly uncertain times. We've got Brexit, high on the agenda. We've got Donald Trump in America. Every time he tweets, it seems to ricochet all around the world and markets. However, it's not such a bad thing, and sort of saving for your retirement is really long term. Investing is for the long term, and what we do find is that when there is uncertainty in markets and when markets are going up and down, it really does create a lot of opportunity. Ty Busada, he's one of the fund managers that we use. Volatility is a friend, because what it does, it creates opportunity. They find great value in companies. When companies fall in value because their shares are falling, they look at that as a great opportunity to say, right, good value to buy that share, and I'll bring that into the fund. Over the longer term, that will definitely benefit you. So volatility, I don't think is anything to be concerned about. It creates a lot of opportunity. And as long as you've got that long-term high time horizon, risk is definitely a good thing. This graph just shows and illustrates diversification. So diversification is really, really important, and it helps reduce risk. This shows it goes back for the last 5 years, so 2014, 15, 16, 17 and 18. And what it shows is different markets and which was the best performing market in each of those years. And you can see it's completely different every year. So there's no way of actually predicting where to invest your money or where best to invest your money. The only way to do it is really diversify. So with any investment that you have, make sure you do have exposure to different assets. In one of those years, one of those assets will work for you. It's a really good way to reduce risk with investments. So investments and risk sits alongside time horizon. So time horizon will be how long you've got for your money to be invested. So if you are, maybe 20 years from your retirement now, that for me is a long time. So you could comfortably take, potentially upper medium levels of risk. However, if you're in maybe the 5 to 10 years before retirement, you don't have as long for investments to work. So we'd look to scale back the risk. So in that time frame, probably somewhere around medium risk. If you're going to be using that money in the next sort of 5 years, again, we want to be fairly cautious, because we want to make sure that if markets did take a downturn, that your investments aren't going to be significantly affected. So risk is a strategy that needs to be constantly reviewed. So a couple of points just to leave you with. So almost everybody, we do have to save more for retirement, unfortunately. If you don't accumulate enough, there is a risk you could always outlive your savings. Consider the life that you want to lead in retirement. Have a think about what your goals and your plans are, and determine how much you will need to save, which is what we can definitely help you with. Commit to your plan and take action. Really important, whenever you've got investments, whoever they may be with or whichever financial advisor you choose to use, really, really important to review all the time on an annual basis to take advantage of your tax planning opportunities, but also make sure you're in the right levels of risk and you're making the most of the situation you have. So definitely I'd encourage everybody to review their financial plans at least once a year. So this is our company, so Capstone Financial Management. We've got a few advisors dedicated to helping the partners of gunnercooke, so we are here to support you and we've got a huge amount of resource and support. So again, there's my details. I'll be very happy to obviously sit down with all of you and start to work on plans. And we will give you a call over the coming days just to obviously take your feedback and see if you found today's seminar useful. And then take some feedback, and then if you want to sort of arrange a meeting in the future, we can look to put that in the diary. And finally, you've got our contact details. So I hope that everybody's found that interesting. There's been some good points on there, and I look forward to catching up with you all very soon. Many thanks, and have a good day.